Welcome back. Dramatic moves in the Treasury market this week. Yields in the 10-year, they were below 4% when President Trump announced tariffs on April 2nd, what he called Liberation Day. They have now jumped to over 4.5%. You can see where they are right now. Let's discuss the outlook for rates and inflation. Joining us is Jim Bianco, president of Bianco Research. Jim, we talked a lot about the bond market on Tuesday and those moves. I think we hit 4.5%, and then many of us believed in part the decision to roll back tariffs was done to ameliorate some of the pressure in the bond market. Doesn't seem to have worked. What are your thoughts?
Yeah, it hasn't worked. I think what everybody's missing here is that the bond market is now getting worried about inflation. And look no further than today. We got a great PPI report after a great CPI report, and we got no movement on the bond market on that. And then we get the University of Michigan saying that inflation expectations go up, and we go shooting through 450. That's about what's coming next, and that's tariff-driven inflation, and that has changed the dynamic within the bond market. And all this talk about leverage unwinds and banks selling and whether or not the Chinese are selling and all that other stuff, that's just an accelerant on the bigger move here, and that is that there's been a fundamental change in the way that we're looking at the world because of tariffs. Now we're worried about higher prices.
I mean, Larry Finks also sort of sounded that inflation alarm and attributed the bond move. I think there's something else going on, though, Jim, when, the 10-year moves 50 basis points at least in a week, and Fed funds only moves 15. And inflation expectations in the bond market are actually falling and not rising. So this question about who's selling and why, doesn't it come back to sort of bigger factors around the U.S. exceptionalism trade?
It can, but I think really what we're talking about here, and that's a good point, is that we've had a 50 basis point rise in the 30-year right now. And by my records, that's going to be the biggest weekly rise since 1987, if this holds throughout the rest of the day. Yet, we've only got a 28% chance the Fed is going to cut rates in 3 weeks. Normally when you see something like this, we'd be talking about the Fed cutting rates this afternoon, let alone waiting 3 weeks. Why is it that the Fed is not going to be playing in this game? I think it's because of what Jay Powell said last week, and I'll paraphrase it. If you've got weak growth and you've got higher inflation, inflation wins. They all want to be Paul Volcker and fight inflation. They don't want to be Arthur Burns and be cutting into rising prices. So the Fed is out of the equation. That's the other thing I think that's really going on here with the market is everybody had these positions on, thought, if things get ugly, the Fed will come in, they'll print money, they'll cut rates. They're not coming in. And that's what's also kind of been a big revaluation in the market's thinking.
Well, they might come in if there's liquidity issues in the bond market, aside from cutting rates.
It's got to get a lot worse. It's got to get a lot worse for that to happen. So, in other words, as messy and as upset as everybody is, this isn't even beginning to, get the Powell put into this market right now.
What does a lot worse look like?
Oh, it looks like '08 is what it would look like. I'm not saying that we're going to do that. I'm just saying that if you're holding out hope that the Fed is going to magically cut rates, that's not going to happen. Why? Because if they did it now, or if they tried to come into the market now, I think they could have a toxic reaction like they did last September. The market's worried about inflation. You start easing and stimulating with lower short rates, you could wind up pushing long-term rates even higher. Just like last September when they cut rates 50 basis points because they were worried about the payroll report or the labor market, yields went up 100 basis points by the end of the year. So that's the other thing. So it's got to get so much worse that you just got to get rid of the whole inflation thought in the first place. And that's not coming. That's not here right now.
Yeah, well, the Treasury Secretary has made it fairly clear one of the key goals of the administration is to get rates down. We've got big refinancings coming up, want the interest costs for the budget to perhaps be less of a weight. What do they need to do to accomplish that?
Well, first of all, I'll remind everybody the Jim Carville line from 30 years ago. When I get reincarnated, I want to come back as the bond market because it intimidates everybody. And I'll just add on to that. Jay Powell doesn't control the bond market. Scott Bessent doesn't control the bond market. Wall Street doesn't control the bond market. It is an animal unto itself. And it decides what it wants to do, and it goes where it wants to go. If you want to get the yield down, you have to enact policies that the bond market likes. That is, policies that will bring down inflation, and tariffs don't do that. Policies that will give us better, more efficient non-government growth, and we've just got a gigantic budget deficit right now, and policies that would make people feel that the dollar was more of a safe haven, and we don't have that now either. Now, maybe we will get that soon, but I think that that's really what you can only do. You cannot manipulate the bond market anywhere you want to go, and I think we found that out this week.
I want to talk about the U.S. dollar versus the Chinese currency, because a lot of people are watching this one as well. And I don't want to get too technical, but it relates to this whole discussion. If you're worried about China selling U.S. Treasuries, they set their currency, right? They manipulate it. Right. And everyone's worried that they're going to devalue their yuan to help the export sector. What if they're stepping in to stop their currency from going into free fall? I mean, we don't know exactly what they're doing and why, but there is this risk out there, and people are watching it every single night, and that helps inform what's going to happen with Treasuries and the dollar overall. What do you see?
Yeah, no doubt about it that, that we are looking towards the idea that China owns hundreds of billions of dollars worth of treasuries. We're in a trade war with them. Would they use them as some kind of a weapon? Now, China also maybe owns 40% of their treasuries through legal entities in Europe, primarily in Belgium and Luxembourg. They did that after 2014 when we tried to freeze the assets of Russia after they invaded Crimea. It was a warning sign to them that they had to get them in other places. So when you see the selling that is coming out of Europe, in a big way, because European yields are going straight down as our yields are going up and the dollar is going straight down against the euro. You can look to say who in Europe is selling aggressively treasuries and buying European bonds that their yields are falling so much. And then you got to remember the Chinese have hundreds of billions of dollars in European entities, too. So it's not just, China and the yuan that we have to look overnight. We have to start considering the euro as well. And this has only been happening in the last 2 or 3 days.
Jim, thank you. Appreciate your perspective.
Thank you.
I mean, the equity market is taking all this bond selling